Good evening, all of you. I'm sorry I have to tell you one thing before going for admission of a partner. And that thing I'm going to complete, and after that, I'll go for the other two important aspects of goodwill. After fixed capitals and fluctuating capitals, we'll come across distribution of profits or losses among the partners. See, when you go for partnership business, we'll prepare the trading account and profit and loss account. In profit and loss account, whatever it may be the result, we'll take that as net profit or net loss. And in sole trade businesses, we'll transfer that net profit or net loss to the capital accounts and we'll prepare the balance sheet. But here in partnership business, whatever it may be the net profit or net loss, whatever we come across, it should be transferred to a separate account, and that account is nothing but profit and loss appropriation account. Okay, in this profit and loss appropriation account, we'll come across, okay, the adjustments regarding the partners. We'll come across the adjustments regarding the partners. So what are the adjustments that we come across in this profit and loss appropriation account? The first one is interest on capital. See, the partners, they are keeping their amounts in the business and they have to wait for a long period of time to get back their amounts, to get back their capitals. So up to that extent, as their capitals, when they are blocked in the business, it is the customary duty of the business to give some benefit. And that benefit, whatever the business is going to give to the partners, is nothing but interest on capital. And interest on capital, we have to calculate per annum, per year. That is, after completion of 1 year, we have to calculate, okay, taking into account the rate of interest, okay, and we have to give the partners the interest on capital. At the same time, we'll come across interest on drawings also. So what are drawings? Drawings are nothing but the amounts drawn by the partners from their business for their personal purpose or for their personal use. And these drawings may be in the form of goods or in the form of cash. Because the partners, they have to wait for a long period of time, that is 1 year. Meanwhile, they require some, they'll come across some expenditure personally, or their personal requirements also they will come across. In such case, the business, it will allow the partners to take some money or cash or goods for their personal use. So those things we'll call them as drawings. And it is the customary duty of the partners to return those amounts, okay, back to the business. Because the partners, they have to treat the business as a separate person. They should not consider that business is mine and I am the business. Like that, they should not. When they consider, okay, like that, there won't be any profitability and there won't be any business. It is not called as a businessman. So whatever it may be the business, you have to identify your business as a separate person. You should not say that my business, I am the business and my business is mine. So like that, you should not take into account. You have to treat your business, whatever it may be, whether it is small or big or whatever it may be, as a separate person. So when you are treating the business as a separate person, it is your customary duty to return the amounts back to the business, because business is allowing the amounts, okay, from business you are getting the amounts. So when you are not returning in proper or specified time, specific time, then the business will charge some interest on that, and that thing will call that thing as interest on drawings. And here the peculiarity comes. When you are going for drawing, interest on drawings and interest on drawings, you will come across a peculiarity Okay, apart from this interest on capital, because interest on capital, it will be calculated per year. But here you will come across a difference in this interest on drawings. When any partner, when he's taking the money at the beginning of every month throughout the year, throughout the year, okay, he has to pay back to the business 6.5 months interest, irrespective of the rate of interest. 6.5 months interest he has to pay to the business. Okay, when any partner, when he takes the money from the business at the end of every month throughout the year, he has to pay 5.5 months interest, irrespective of the rate of interest. And when any partner, when he is taking money in the middle of the month throughout the year, okay, then he has to pay 6 months interest, irrespective of the rate of interest. This is a peculiarity that we come across when we go for interest on drawings. Similarly, when partners, when they are doing the business as employees, they are supposed to get the salary, and the business is going to give them some amount as salary. And when any partner, when he's taking the opportunity or taking the risk of selling the commodities, then the business will allow that person, will allow that partner some commission amount. So salary to partners or commission to partners. And one more thing is, okay, when any partner, when he takes some loan from the business, okay, he has to pay the loan and he has to pay the interest. So interest on loan, interest on loan, the partner has to pay to the business. And that interest, it is nothing but a income to the business. So that thing also we have to take. And sometimes the partner will give some loan to the business. In that case, the business has to pay some interest to the individual partner. That thing also we have to take into account. So all these adjustments we have to show separately in profit and loss appropriation account. And whatever it may be the difference, whatever it may be the result, whether it may be profit amount or loss amount, whatever it may be, it must be shared among the old partners in their old profit sharing ratio. Okay, so with this, okay, we can say that there will be a distribution of profit amount or loss amount, okay, after taking into account the fixed capital and fluctuating capitals. This profit and loss appropriation account, it is compulsory when we go for partnership businesses. That's why when we are preparing the final accounts of partnership businesses, we have to take into account 5 statements. Why is it? We have to prepare 5 statements. What are the 5 statements? Trading account, profit and loss account, profit and loss appropriation account, partners capital accounts, whether they may be fixed capital method or fluctuating capital method, whatever it may be, you have to prepare the capital accounts of partners. Then only you have to prepare the balance sheet. Like this, you have to prepare the 5 statements in partnership business. When you go for sole trade business, there is no necessity for you to prepare the profit and loss appropriation account. There, you have to prepare trading account, profit and loss account, and immediately you can go for balance sheet. But here in partnership businesses, you're supposed to prepare, okay, trading account, profit and loss account, profit and loss appropriation account, okay, partners capital accounts, and balance sheet. 5 statements you have to prepare. So this thing I forgot to tell you. Okay, I'm sorry for that. And now I completed that. I completed that. And now we are going for the 2 important adjustments that we come across in admission of a fund. I told you treatment of goodwill, okay, undistributed profits and losses, as well as sacrificing ratio, that is profit sharing ratio. Okay, three things, three adjustments I completed in the last video class. Now we are going for the fourth one. The fourth one is revaluation of assets and liabilities. Revaluation of assets and liabilities. When any partner, when he is coming into the partnership business, automatically the values of the assets and liabilities, they will change. They will change. And some assets values will increase and some assets values will decrease. In the same way, liabilities values may increase or liabilities values may come down. Whatever it may be, the changes that we come across in the values of assets and liabilities, we have to take into account and we have to transfer to a separate account known as revaluation account. Okay, in this context, I'm going to give, when you take a pond of water and when it is cool, okay, when it is calm, okay, you won't come across anything. The water will be in a cool manner. Suppose if you take a stone and if you throw that into the pond of water, automatically you'll come across some waves in the pond. That is, the pond is disturbed. Why it is disturbed? As you had thrown a stone into that, okay, automatically the water will be disturbed. And this disturbance, okay, water may waves, small waves. Okay, that is, we can say that the pond is disturbed. In the same way, when you come across admission of a partner, when any partner, when he's coming into the partnership business, automatically the value of assets and liabilities, they will change. Okay, some may increase, some may decrease. All these disturbances will come across. And all these changes, whatever we come across, whether there may be an increase or whether there may be an increase and may decrease, all these things we have to transfer to a separate account known as revaluation account. And when all the changes when they are transferred to revaluation account, we have to see what is the net result, whether we got profit amount or loss amount. Whether we got profit amount or loss amount, we have to see. And that profit amount or loss amount, it should be shared among the old partners in their old profit sharing ratio. That is compulsory. And there is no necessity for you to share that profit amount or loss amount to the incoming partner, because on his admission only the changes the came. That's why whatever it may be, the profit amount or loss amount by the changes in the values of assets and liabilities, they must be treated as profit or loss and they must be transferred to the old partners in their old profit sharing ratio. This is the fourth adjustment that we come across. And fifth adjustment is proportionately sharing the capitals basing upon the incoming partner. Proportionate change in capitals. Okay, sometimes what will happen is the incoming partner, what is the capital amount that is bringing and what is the share that we are giving to him. Basing upon the share and basing upon the capital amount, the existing partners, they will go for the capital calculation of capital amounts. So those things, we'll call them as new capitals according to the proportionate change in the capital accounts basing upon the incoming partner share. So when the capitals, when they are changing, we have to take into account what are the old capitals of the partners and what are the new capitals of the partners, and what we have to do with this difference. This difference, whatever it may be, either we have to try pay or we have to take the cash from the partners sometimes, and sometimes we have to transfer that to the current accounts when we are following this fixed capital method. When you go for fluctuating capital method, okay, when you go for fluctuating capital method, whatever it may be the difference, that difference, either the partners have to bring the money into the business or the business has to pay to the individual partners, the difference amount. So like this, you will come across the fifth adjustments. And all the fifth adjustments you have to take into account, and then only you can be in a position to go for admission of a partner. Okay. Next, we are going for the retirement of a partner. What is this retirement? When any partner, when he want to take rest, or when he is not at all interested, or when he became fatigue or boredom in carrying the business, he will inform that I want I want to retire. I want to retire from this business. So that thing he has to inform to his co-partners. And when the co-partners, when they accept, then only you will come across the retirement of a partner. Okay. Here, mind that the partner, he has to inform that to the remaining partners. Okay. About his retirement, about his taking of rest, about his non-interest in the business activities. All these things he has to inform to the remaining partners. And when the remaining partners, when they accept, then only you will come across retirement of a partner. In retirement of a partner, that is when a partner is retiring. Okay, there also you will come across some adjustments. There also you will come across adjustments. What are they? First one is gaining ratio. When any person, when he's going from the business, means that person's share, it will go to the old partners or the existing partners. It will go to the old partners, and the old partners, they will gain. They will gain. Okay, by the retirement of a partner, or by outgoing of a partner. Okay, so that thing we have to take into account, and it is known as gaining ratio. So how this gaining ratio will come? New ratio minus old ratio. It is quite contrary, it quite contrast to sacrificing ratio. In sacrificing ratio, old ratio minus new ratio, that is sacrificing ratio. When you go for gaining ratio, reverse the same thing. New ratio minus old ratio is nothing but the gaining ratio. Okay, so what is happening is the outgoing partners share, it will be distributed among the remaining partners. Then the remaining partners, they are going to get his share equally, or basing upon the terms and conditions, basing upon the agreements what they will come across. This is one important thing that we come across in retirement of a partner. And whatever it may be the reserves, whatever it may be the partner may profits and losses that we come across until the date of retirement, they must be shared by the partners in their old profit sharing ratio. And third one is goodwill. Goodwill, this is also very very important. And this remaining partners, they will take the share of the outgoing partner, retiring partners share of goodwill. These people, they are going to get in their gaining ratio. Suppose if gaining ratio is not mentioned, then we have to take into account the old profit sharing ratio, and in that ratio, they can take the goodwill amount. That is outgoing partners or retiring partners share of goodwill. Okay, then after that, you'll come across the revaluation of assets and liabilities. Okay, when any partner, when he's coming into the business, or when any partner, when he's going out of the business, then automatically you'll come across some changes in the values of assets and liabilities. And whatever it may be, the changes in the value of assets and liabilities, you have to transfer to the revaluation account. And whatever it may be, the profit amount or loss amount that you come across, it must be shared by the old partners. Okay, by the old partners. Okay, so this is about this thing. And the next important thing that you have to concentrate is whether the partnership business is having enough cash with it or not. It has to see, because whatever it may be, the share of the outgoing partner, you have to pay it to him. That is the capital amount, all those things, interest on capital, all these things you have to take into account, and you have to give him, because he's going out from the partnership business. So whatever it may be, the amounts that belongs to not that belongs to the outgoing partner, you have to pay him. And when you are having enough cash, you can pay that amount to the outgoing partner. Suppose if the cash amount is very, very less, then the existing partner, I mean the remaining partners, they have to go and they have to request the outgoing partner that they are going to pay him in the form of loan, in the form of loan, or in equal installments we are going to pay that amount, because as the cash position is not good, we are going to pay in the form of loan, and that too in equal installments, and we are going to give, okay, interest also. So what is the amount of interest that you are anticipating? Suppose if the outgoing partner, if he mentions any rate of interest, these partners, if they agree, they'll give in that rate of interest. Suppose if the outgoing partner, if he won't mention, okay, any rate, then the remaining partners, they have to pay 6% per annum, or 6% per annum interest amount. And whatever the equal installments, whatever the installment that they are paying, they have to take into account that thing, and they have to pay the interest amount. And in most of the cases, in most of the cases, you will come across the loan payment only. That is, whatever it may be, the dues that are to be given to the outgoing partner, we have to transfer to the separate account, that is partner's loan account, and we have to transfer that amount. And whatever it may be, the method of payment that you are giving, that you are making, you have to take that and you have to prepare. And at the end of the period, at the end of the period, the loan account will be set to be closed. That is complete payment or final payment you have made to that outgoing partner. And after that, you won't have any contact with this remaining partners or in the business. You'll go out from the business. This is nothing but retirement of a partner. Okay, now after that, we will come across death of a partner. Okay, this death of a partner, it is equivalent to the retirement of a partner. But the main difference that we come across in retirement of a partner and death of a partner is, in retirement of a partner, the physical existence of the partner you will come across. But when you go for death of a partner, the physical existence of the partners you won't come across. Okay, remaining things, whatever it may be, remaining things, they are one and the same, like that of retirement of a partner. So what the dues are to be done, we have to pay. Okay, whatever it may be, the dues that are to be paid, they must be paid to their executors. That is, deceased partners executors we have to pay. Okay, and another thing is important thing, the existing partners, the existing partners, they have to pay some amount, some amount on humanitarian grounds to the executors, because that deceased partner, he is in the partnership business. All of a sudden the death occurred and that person's main appearance is not there. So on humanitarian grounds, the existing partners, they'll give some share, okay, some share of profit, okay, to the deceased partners executors. That thing you will come across when you go for death of a partner. This is how you will come across admission of a partner, retirement of a partner, and death of a partner. And the remaining two things we are going to see in the next video class. Until then, have a nice day, and please subscribe to my channel.